Hello, everyone. Welcome to the Safe House, brought to you by the Safe House Initiative. I'm Jeff Edwards, co-chair of the Safe House Initiative and your host for today's podcast. We have a very exciting program for you today. This episode, I'm joined by two gentlemen from Alliant Insurance Services, David Finz, First Vice President of Specialty Claims, and Adam Rauf, Senior Manager of Cyber Risk. David and Adam are here to discuss cyber risk quantification, better known as CRQ. Gentlemen, thank you for joining us today. One of the things that we discovered along the way is in our conversations with the cyber insurance industry, there's a huge need for more information, consolidated information, and easy to find, not a big awash of, all the different controls I need to get a cyber insurance policy. And there's many subjects that, we have to study up on, and we make it available here at the Safe House Initiative. So one of the first things I discovered a few months ago is I saw a podcast on CRQ, which is Cyber Risk Quantification. And it was hosted by David Finz, as you see here. And David Finz is with the Specialty Claims Group at Alliant. And then David said, let's dig into this a little deeper. And I said, if you could record it with somebody who's an expert in this particular area, which fortunate enough to have Adam Rauf, who's with the cyber group at Alliant, and his focus is on cyber risk quantification, and he's going to share some thoughts on it. To where, as many of the users found this site very interesting, is in the SMB space, limited budgets, limited staff to really dig into really reducing their cyber risk. And Adam's going to break it down from a larger scale down to a smaller scale, how you can take it and start to implement CRQ in your organization. So without further ado, I'd like to ask David if you wouldn't mind talking about kind of the current state of claims and how CRQ can fit into the mix in reducing risk.
Thanks, Jeff. Pleasure to be here. The difficulty that we have in terms of advising clients around what limits they should purchase, what they should anticipate a foreseeable loss to be, is that the cyber threat landscape is continually evolving. So underwriters and brokers looking at loss runs and looking at the data they've been able to amass over the past several years, we are inherently looking in the rearview mirror, right? A couple of years ago, there was a point where cyber extortion coverage was almost a throw-in on cyber insurance policies. And then it became the driving force around losses. And so because of the nature of the threat constantly changing, and because cyber incidents tend to be vertical in nature, if a company has one, it is likely to blow through most, if not all, of the limits of their policy, right? It's not like certain lines of coverage where there may be losses, but they can be manageable. They're within the company's self-insured retention. A cyber incident is going to register on the Richter scale. And so the challenge we have is advising clients what limits they should purchase based on historical data that may no longer be as relevant as it was when the incident first occurred, because of the changing landscape. And that's where being forward-looking in terms of our analysis comes in. And that's why we're grateful to have folks like Adam on our team who can actually provide, a more rigorous quantification of loss. And with that, I think we should bring Adam into the discussion here, because he knows far more about being able to crunch those numbers, than a word nerd like me ever would. So.
Yeah, thank you, David. I appreciate it. So my name is Adam Rauf. I'm an information security practitioner of over 10 years. And I've always been somebody who always thought of things in kind of more black and white kind of terminologies, right? In terms of understanding, you either have a control or you don't, and understanding information security from the perspectives of vulnerability analysis, digital forensics, incident response, e-discovery, things of that nature. And traditionally, I've spent all of my time working more in helping clients recover from types of cyber incidents, especially from ransomware. And, I used to not be anybody who was well versed in anything insurance related or really cyber risk quantification. But several years back, and a former CISO of mine, Omar Khawaja, actually got us to start thinking, and this is probably before cyber risk quantification kind of became like the marketing buzzword, right? In looking at FAIR, which is factor analysis and information risk. And so I actually got Open Fair certified back in 2019. And so I think that I appreciate the fact that I started learning about that, years ago, because I think traditionally when people have thought about risk quantification, it's really been more risk qualification. They focus on the reds, greens, and yellows. They think about security maturity in terms of CMMI or other scales where you want to go from a 2.8 to a 3.2. But I think when you start getting into the numbers and talking to your board and getting funding for your security tools and projects, it's a lot harder to make that sell when you say, I want to go from a 2.8 to a 3.2, or I want to go from a yellow to a green. It's a lot easier to say, hey, I have a risk. If we get exposed, we could lose potentially $30 million. If you give me 200K to implement this security control, I can offset our risk by 50%. That resonates a lot better with the CFOs, CEOs, CTOs of the world, because now you're starting to put these things into dollars and cents. And, this is one of those things that's been challenging for a long period of time. I don't think that most people have spent the time in actually doing that analysis. And so to your point, David, I think the challenge that most organizations have is actually thinking about, how do I measure my security posture versus the security spend? How do I show that security ROI back to my executive board? And so when we started talking about cyber risk quantification with different clients that we worked with at Alliance Cyber here, right, we started talking to them in terms of, what do you want to do? And let's figure out how much that potentially impacts, what you're doing, right? And I think that on top of that, then you take that back and you measure it kind of against your insurance policy. And so now you've got a mapping of, what does my risk look like from a first party, third party loss perspective? And then do I have sufficient insurance coverage to cover that? One of the things that I would also implore folks to do as part of this insurance piece, and David, you can certainly chime in if you'd like to here, because I think that you are the word nerd in this case. Recently, we just spoke to a client who was talking about reputational loss and business interruption, and starting to think about that in terms of, do I have enough insurance to cover those things? And, previously this client actually didn't have reputational loss damage, and it was actually kind of a trivial increase in their overall premium to add that clause, right? And that was something that mattered a lot to that client. And so I think it's really important that as you go through this process, and I'll talk about the tools and technologies and things that you can implement to do that, that you also, if you are seeking cyber insurance as part of helping to transfer that risk, that you're also having conversations with your risk office, your GRC group, and you're talking to the folks who are doing insurance both on your side, but also with the carriers themselves and the brokerages, to determine whether or not you have sufficient coverages for those types of losses. David, before I go into the tools and technologies, is that I definitely want to lean on you, because I know that you're more of the expert in that space.
Yeah, reputational loss, or rep harm as we sometimes refer to it, is a coverage that's, really what we describe as an enhancement. It's one of those things that's not going to likely be in the base policy form. It's something that needs to be negotiated by the broker and added by endorsement. It may, as you suggested, entail a small additional premium. However, what this does is it recognizes that the impact on a company for having a business interruption may last beyond the event itself, right? After the lights come back on, so to speak, right? After the network is back online, you may still experience a loss through canceled contracts, loss of consumer confidence, et cetera, right? I mean, just as an example, right? I once had a client who was in the entertainment space. They were ticket brokers. Their clients ultimately were the venues where artists performed, concert halls, performing arts centers, nightclubs. When they had a business interruption, it, I don't think, lasted more than 5 or 6 days. But as a result of that incident, many of these venues started to pull business from them. Some even canceled their contracts altogether, even though there was a penalty for doing so. And so the impact for this event that lasted under a week could go on for months or years if they, lost that business and it wasn't coming back. Now, to be fair, I don't mean to suggest that the underwriters are going to cover, prospective loss 2-3 years out. That could be quite speculative in nature, but they will typically prorate this for a period of, say, 120 or 180 days. And during that time, to the extent that we can quantify what the baseline would have been and what the resulting revenue was because of the customer attrition, there is a way to recoup a portion of those losses. And, this is the type of stuff that needs to be taken into account in risk quantification. People think of cyber as a short tail event because so many of the costs occur up front. We are beginning to see, due to customer attrition, due to regulatory proceedings, and even third-party litigation, that cyber is beginning to get a longer tail. And as a result of that, it's all the more important to be able to look out prospectively at what the longer-term impact to an organization might be.
So, David, quick question for you. It's the tail, that the back end. Is that quantified at some point? Is it 10 times bigger, or is it 5 times bigger than the event itself, or is there some kind of order of magnitude that, because I've heard that the tail is really expensive. I mean, it really is costly.
Yeah, I mean, I again, the nature of the risk is changing. And so I will leave it to the resident mathematician in the room to talk about kind of how they quantify that. But again, 2015, 2017, people thought of cyber as, well, you had a data breach. So you have to bring in the lawyers, bring in the forensics, get the notices out, set up the call center, offer the credit monitoring. All of that still happens, but that's sort of the first wave of cyber, right? The second wave of cyber risk was really the business interruption. The third wave was the ransomware. And now we're beginning to see this fourth wave around, I call it death by 1,000 cuts, social engineering, right? Cyber crime, invoice manipulation, fraudulent transfer of funds. Those may not be on the order of magnitude the largest events, but they can do some real damage to a small business, and they're more frequent than people could care to admit. Point is that this is like a multi-headed hydra, and we have to look at it in that way. But again, some of the exposures, some of the losses that the underwriters are now grappling with do have a longer time horizon on them. Things like reputational harm, things like the regulatory proceedings that companies are now finding themselves responding to because their regulatory overlords, whether they're industry specific or at the state or national level, are now requiring some minimum cybersecurity standards or reporting requirements. And so they can be on the receiving end of inquiries from those enforcement authorities as a result of some alleged noncompliance. So those things can go on for months or even years. They're not in the same horizon as the shorter term losses that we were grappling with in the 2010s.
Thank you.
Yeah. And David, one of the things I think you touched on, which is really great, is the long tail, right? I think most people, when they think about a cyber incident, all they think about is how much is the ransom going to cost me? How much do I have to pay instead of response? And they're kind of ready to move on. But when you start getting into forensics, e-discovery, litigation, third-party lawsuits, paying for credit monitoring for your customer base and things like that, all of those things add up. And I think people often discount it and just think that, oh, I don't have to worry about that. I just have to worry about the cost of the incident. But as you pointed out, you lose customers, you lose confidence in the marketplace. I mean, in some cases, some businesses ended up shutting down after a cyber incident because they weren't adequately prepared to deal with the losses. They thought that they had enough insurance, or they thought that they have enough controls. I always talk about cybersecurity in this way, and I hate to be pessimistic around it, right? But I want people to understand that the idea of an incident occurring in your environment is now more an option. The discussion is more around when it's going to happen rather than if. I think most organizations falsely assume that I'm not a big enough target, so I'm not going to get hit. I can tell you just from working on a myriad of ransomware cases over the years that, even small nonprofits come back and they're just like, we got hit. This threat actor even told us that they didn't attack nonprofits and they came after us. there's schools that are taking care of children, there are hospital systems that are helping, hospices. Like, there is no honor amongst thieves, right? And so I always tell people that they should rather prepare themselves rather than expect that they're not a big enough target to be considered. So even when we talk about small business, large business, enterprise, it doesn't matter. All right, at this point, I am going to sharpen up my pencil here, and I want to push my glasses up because I'm about to talk about some nerdy stuff here, right? So you guys are all probably wondering, okay, well, I hear about the cyber risk quantification thing. How do I do it? So I think about a number of different things. There's a number of different frameworks that are out there. They have free templates for this, for doing this kind of stuff. So if you have a GRC team, or you have people who are nerdy enough that want to do this kind of stuff, like myself or David, then there are frameworks to do this. The one that I mentioned earlier, Factor Analysis of Information Risk, FAIR, is probably the most well-known cyber risk quantification model. It is not the only one out there. So I don't, even though I'm a big fan of it, I will say that there's a number of other ones out there that you can also utilize. NIST has a means of doing cyber risk quantification. There's one made by my former colleagues at CERT called the Operationally Critical Threat Asset and Vulnerability Evaluation. Most people just know it as Octave or Octave Allegro. That is a free template you can use to start building out cyber risk. And what I will say that I think is common amongst all of these risk management frameworks, before I provide more of these tools and technologies and frameworks, is that the idea around understanding risk isn't something where you're going to have a precise dollar amount. You're always going to work around, I think the terminology here is that you don't focus on precision, you focus on accuracy. And so when you start with kind of an absurd number and then continue to whittle it down until it actually makes sense for your organization, that's when you start getting into the ballpark of understanding what that overall risk looks like. And I typically think of everything as like a bell curve. So you've got kind of like your most likely, and then on both sides of it, you have the least amount and the most amount, and you've got this range that you got to work with. And so you start figuring out, how do I move this curve over to the left? And that can be through risk transfer, which could be through insurance, risk mitigation, which is going to be through applying different controls and technologies to either reduce the susceptibility of being hit or reducing the impact that it causes from a particular loss. So I did want to get into the other frameworks. COBIT actually has their own cyber risk quantification methodology. So that's control objectives for information related technology. And then there's also another one called TARA. It's threat assessment and remediation analysis. So as I mentioned, a number of these frameworks, FAIR, NIST, Octave, COBIT, TARA, have free resources available online for you to start doing this. Now, there are tools that can help you accelerate this process, right? And the first I'm going to mention is actually one that I just found out about a couple of months ago when I was talking with a former colleague of mine, Brandon Franklin, who actually uses a Python implementation of doing a FAIR analysis called PyFair. This is available on GitHub. You can Google for it. And so now you can do a FAIR analysis of your own environment with a free tool. There's a number of other tools out there. Safe Security has the Risk Lens product, which is probably the most well-known in the world in terms of doing cyber risk quantification. Axio has a product to do that. NIST has their own called PRAM. It's the Privacy Risk Assessment Methodology. It's not as robust as you'll typically see within FAIR, but again, it's a crawl, walk, run kind of perspective. I'm a former Archer user, or recovering Archer user, I suppose. And I believe they actually just implemented a cyber risk quantification module recently. I just found out about that as well. And certainly, even if you're trying to do this by Excel spreadsheets, it's better than not doing it at all. But what I will say is that tools like PyFair and these other technologies that I mentioned, like Risk Lens and Axio and things of that nature, the idea behind it is not only that you take all of this information and you kind of decompose it, right? So FAIR, you think about, and this is utilized across a lot of these methodologies. You've got the overall risk. The risk event might be something like you have ransomware. And so you start breaking that down and decomposing it. Well, what's the chances that it's going to happen? And what's the type of loss that you could end up with? And then the chance of it happening, let's think about who are the potential threat actors that are coming in and what are the particular vulnerabilities you have. You know the skeletons in your closet. Maybe you don't have MFA enabled everywhere. Maybe you have RDP kind of openly accessible. Maybe you've got CVEs that are sitting over from technical debt that you haven't been able to replace. But you have a pretty good idea of that. And then you start figuring out what's the motivation and what's the chances that I'm going to be attacked and what controls do I have in order to offset that loss, right? And then you start thinking about, if you do get hit, what does that loss look like? And then all of that secondary risk, which is the long tail stuff, those are the things around like, what happens when I lose customer confidence? What happens when I have to deal with civil litigation, lawsuits, and credit monitoring, and all of these other losses, right? And so you start thinking about that holistically. And so what I try to do is get people to think about that in terms of understanding the loss. And then you go and take a look at your insurance policy. And as I said, talk to your folks internally about this, talk to your brokerage, talk to your insurance carrier, get a really good understanding of what your policy covers and what it doesn't cover. And now you've got a really good idea of whether or not you're going to be able to cover that loss with the insurance you have, or maybe you need to start thinking about that risk. I'll send you a list of all the tools and frameworks that I mentioned, along with URLs, so that people can start exploring those. And so what I mentioned with the tools that are available, aside from PyFair and a couple of the other ones like Pram, right? That though the other tools are typically a software purchase or subscription based, and right. So the idea behind that is whether or not you want to build it yourself and try to do it, in which case you can use things like PyFair and Pram and these things, or you purchase a tool that can help you arrange all of this data so that you can do that. And so I like to let people know that there are always free options available and there's always premium options available. And so you should consider that based off of what do you think, as far as from a business perspective, do you want to build that maturity yourself? Do you want to use a tool? I mean, many of them have POCs available that'll let you trial it out for 30 or 60 days so you can see whether or not you can incorporate it. But the important thing is, when you go through this process, is don't shortcut anything. You don't have to boil the ocean, but don't shortcut anything, and make sure the right people are in the room when you're having these conversations. So what I mean by that is, typically the risk team will think that, all I have to worry about is the risk team, or all I have to worry about is the IT or security team. But really, the people you need to have in that room are your business process owners. Think about all of the things that you do around business continuity, disaster recovery, and business continuity. You need to have the business process owners who understand how long they're able to survive without their systems being available, and how that impacts you in terms of that loss. So again, people tend to think of the loss of like, I need to replace a server blade, or I need to replace a bunch of laptops. But the thing that happens is that suddenly, you're a retail shop and you can't have sales for 5 days, right? That's a pretty different type of loss that you're probably not accounting for. And if you don't have the business process owners in that conversation, you miss on a lot of that fidelity, and you miss an understanding what that risk looks like. And then you have a much harder time doing the quantification. So I look at it as like the measure twice, cut once, right? And so you got to make sure all the right people are in the room when you do it.
So the business continuity is really intersecting strongly. It's an integral part of the cyber risk, no matter how you cut it, basically. Is that correct? Mm-hmm.
Yeah, I always think of business continuity, disaster recovery as part of it ties well with the incident response process, right? You've got an incident. How do I keep moving on? If I'm a hospital, do I have to now switch to using pen and paper because my IT systems are down, right? If I'm a retail shop, do I have to pick up the phone and start doing orders over the phone instead? So you need to have a good process in place. And so I think of incident response, business continuity, disaster recovery, they kind of work hand in hand, right? And you need to have good processes around all of these. And I implore you, if you're an organization, small business, large business, enterprise, whatever you are, make sure you have a good incident response plan. Make sure you test it. Same thing with business continuity and disaster recovery. Make sure you actually test these things, because when things hit the fan, you want to make sure that you're adequately prepared and that you understand what those risks are to your business or your organization, and not just, again, just in terms of thinking the IT losses. Think about your organization's losses.
Yeah. The cyber and operational risk, basically.
Precisely.
Risk reduction. Okay. Excellent. Any other thoughts, Adam and David, in terms of recommendations how to help their audience at SAFEHOUSE Initiative?
I just think that integrating the risk quantification, integrating the analytics into the claims and underwriting process is so critical, because to Adam's point, right, this helps an organization manage their spend better. They can actually see now how implementing certain controls can reduce their risk, can reduce the likelihood and the expected severity of a cyber event. As a broker, we would never encourage clients to spend money on insurance in lieu of security. I mean, first of all, the underwriters wouldn't tolerate that in this day and age, right? That would be the equivalent of trying to get your client fire insurance without them having sprinkler systems. We want them to see insurance as a backstop, right? Because I don't care how many layers of defense and depth you have, no system is 100% impenetrable. And the human element is always there as well. So recognizing that you cannot stop every conceivable cyber event, you need to have a risk transfer solution to address the losses that you might sustain. But if we can help clients make the case internally for the spend around security controls that will maximize their cybersecurity budget, that will help them reduce risk, that is a value that we can bring to clients and help them find a more rewarding way to manage risk, because that's going to actually deliver for them internally with their stakeholders and say, we chose to spend our money in this way because our risk advisors told us this would be the most effective way to reduce the foreseeable risk. And that's why I think that the tools that Adam is bringing into the discussion are so important.
Yeah,
Absolutely.
I think, David, you pretty much covered it. I mean, from my perspective, when I look at cyber risk quantification, I look at it as it's better to do it than to not, even if you're doing it, as I said, in iterations. Just think of it as something similar that you could do with CMMI models, right? You got to start at the bottom before you can get to the top. You don't need to start with the Rolls Royce before you actually do the work. You need to do the work and spend the time on it. And as you do it more and more, you're going to get faster and more agile at it, and you'll have a much better idea of what that risk looks like to you as an organization. And realistically, it's something that you shouldn't be doing just at a point in time assessment is when you're going to get your cyber insurance. It's something that you should check in with a couple of times a year, right? Just to make sure that as the landscape has changed, especially after the kinetic war happened with Russia and Ukraine, like the world changed quite a bit around that time. You should do a reassessment. When there's a major vulnerability that comes out, do a reassessment. So I always think of it as something as not something where you're just going for an annual checkup, but something that you're always thinking about in the back of your mind and you're considering, doing on a more regular basis.
Absolutely.
Well, Adam, David, I can't thank you enough. You really added some really excellent content to the Safe House initiative that people can enjoy and make use of and maximize their investments in reducing their cyber and operational risk. So thank you, and I'll be talking to you soon. Thanks, John.
Thanks for having us, John.
Thanks.
On your screen are some of the links that Adam mentioned in the podcast, and we've included them in the podcast notes for your convenience. That's our podcast for today. I'm Jeff Edwards for the Safe House Initiative. Thanks for joining us, and remember, be safe, be resilient, and be kind to each other. For more information on the Safe House Initiative, please use your mobile device to scan the QR code on the screen. Send us an email at safehouseinitiative.org@gmail.com or visit us on our website, safehouseinitiative.org. We look forward to hearing from you.